Dr. Rodney here. Hope you're doing well. Happy New Year. Wanted to have a little conversation today about life insurance. Uh, End of the year, everyone gets a little crazy. They think about life insurance. They think about going into the new year. So let's talk about life insurance. I'm going to do a few part series on this, but the first one is there are really only two types of insurance, life insurance. There is what we call term, and then there is whole life. So term actually has permanent life insurance as part of it too. And you're probably wondering what's the difference between whole life and permanent life insurance. Permanent life insurance would be an index UL, would be a universal life, variable universal life. They are all based on what's called a term chassis, and then you have your true term. So term is going to be your most inexpensive insurance to utilize, and then you do have the other permanent types of life insurance. But permanent is can be weird because depending on how well you fund it, how well you put it in there, they may not be as permanent. Whole life is built on a whole different chassis. It's actually built on a whole life chassis. Now you do have more, you have an opportunity to fund it more upfront, like in a 10-year or 15-year, but it's really meant to be there your whole life. It has some dividends in there. It's not generally tied to the market or the bond market. It is generally tied to company performance, usually a mutual company that's basically being a policy owner is you're actually a shareholder of that company through mutual organizations, and you do get a dividend off of that. So when you see a 6% dividend or an 8% dividend or a 3% dividend, there is a guarantee, true guarantee on the whole life. There's no guarantee on the permanent policies, and they have them on what's called a traditional UL or current assumption UL or a guaranteed assumption UL. However, the index and the variable, you really don't have those guarantees. Your real true guarantees are on the whole life product. So it's really a matter of what you're looking for. Whole life can be more expensive, but it's guaranteed to be there your whole life. And so that's why I'm a big believer in doing a lot in term, but then also doing a small portion in whole life. It builds cash value. It can be utilized for different things, but really it's more as a hedge, and it's really to be there your whole life. But having a smaller death benefit on that, doing a lot more term, potentially converting that term later down the road to additional policies as needed, but really locking in some insurability with that. So that's what we're looking at. We'll talk more in this series. You have a great day.